Would you ever spend tax-paid 100-cent dollars when you could spend tax-free 5-cent dollars? I can't imagine anyone intentionally doing that, but that is exactly what happens in traditional life insurance needs analysis. You see, in their desire to minimize the amount of life insurance required to fund survivor lifestyle, financial planners make one very expensive mistake for their clients. It affects both survivor lifestyles and family legacies. I'd say it's being penny wise and pound foolish, as the old saying goes. You see, to save money, they subtract client assets from the assets they want for their survivors. Now, while this may be reasonable if money is very limited, it's still not great advice, and here's why. Replacing pennies on the dollar life insurance with tax paid when purchased 100-cent plus dollars from investments, savings, and rental properties squanders the time, effort, and discipline it took to acquire them in the first case. Using sheltered retirement funds, which happens also, is even worse because it can easily cancel survivor retirement. Not to mention that the tax losses from cashing in these assets are rarely considered in the calculation. Plus, cashing generation-building assets to buy survivor current income means that family nobility is delayed, maybe for generations. So, using personal assets instead of buying life insurance is very expensive both today and later. So please tell clients the whole story about the power of life insurance and let them make their own decisions about how much they want to buy. Deciding for them with traditional needs analysis is costing them a lot of money, and it's not maximizing the value of life insurance either. Hey, would you like to learn how to help your clients protect their families in the best way possible? I can help. Check out jimruta.com. God bless. See you again next week.